It's the Market Sniper. Yes, we're coming at you. It's been a busy week. This has been, last week into this week. It's been the last 2 weeks. In fact, we've made some crazy calls. Amongst those, we have said gold is ready to reassert and break out of its continuation pattern. We particularly like gold against the Australian dollar on an ascending pattern that'll take it through, well through 3,500, potentially 3,600 plus on the dollars, Aussie dollars. So gold is definitely reasserting. Also, we've spoken about Bitcoin being at a triggering event reversal, where it's going to start to get interest again. And we've called 40K and said the play is Bitcoin. The dominance will go to 48%. So don't chase into the smaller coins. Take the liquidity as well as one of the best percentage gains. We had a short on a while back that we were watching and monitoring on small banks, the S&P small banks. That has, of course, caught up with us with all the events of Silicon Valley Bank and Silvergate's its signature rah. We actually have now had the third and second largest bank failure outside of Lehman in American history. That is quite some failure. We've also called the euro to actually gain against the Polish zloty, which could be war related. You could, of course, have the Australian dollar being weak on account of its escalation with China. Who knows whether that's going to be militarily or just property market collapse or any other possible reason. We'll see the reasons later. We trade the charts now. This is why we deliver the news before the news, and this is why you'll be looking at the oil chart just now with me and see that it's down. But why are we here? What is the heading and the title? The bond market has reached a localized high, in my opinion. And you will see subsequent reductions in yields, and that unfortunately means for then a bit of upward value in the valuations. We will, however, not return to the lows of the CV19 event. In short, the bull market has turned. However, you are going to get a rally in valuation on bonds. I will not be, I repeat, not be participating, because the possibility of reset and being caught with old world money into an event that could be brought down upon us and escalate exceedingly quickly would absolutely kill me to be the guy getting into debt on a rally at the end of a 40-year cycle. Much like, yep, you got it, software Silicon Valley Bank did, jumping in with collateral into, you guessed it, the debt markets to capture all the rate hikes and all the devaluations that brought about on their capital. But why are we here? We're here for bonds. So let's just quickly check. There's the tick on some of the calls we've made. We've given specifics on individual equities that we're going short, as well as on the energies. And you could have had this information sooner in terms of how we are feeling. But now, as it's starting to roll over, we're getting we're establishing alibi and getting the fact that we've made these calls out. Inside our premium area, you can find individual energies that we look to short companies, both on the equity side as well as the commodities itself. This is a spill, my friends, and we've called for a 40% drop here. So it's not detailed in that tweet due to limit on characters. But the bond market is where we at. So let's take a little look. We did, of course, call the original short head and shoulders that no one else called on bonds, because everybody is a buy the damn bonds wear diamonds brigade during this era. And in fact, we had that short over there. Many of you know we did in the end make that head and shoulder downside target. And as at the moment, you are seeing an upside swing in bonds. However, this may well take you higher for a bit. It is not a trade for me, because this is the secular top. This is a rally like that in what is now a bear market for debt. It is a rally, and yes, it might get scary, and yes, a bunch of money might flow into both dollars and treasuries. That is Pavlovian, but the new emphasis is on gold over treasuries, and this is where you see the pivoting of money saying, do I want to go debt system as we're at the end of days here, or do I want to actually hold something physical that can't go away? The pure gold link for securing gold and silver is below as well. Pop on there. Remember to click the link and tell them you saw them here on YouTube for special discounts. So we do have equities that are popping at the moment. You can see the alerts are even happening. The US market is opening and is open and is trading. So this is what's going on. But is high yield debt going up with the same vigor? No, sirree. What does that tell you? This is not a search for yield. This is fear. This is fear, and there is actually deep concerns about debt. There is deep concerns about debt. So the pristine, supposedly, government debt, for which there's an absolute abundance and likely more to come under a Democrat government that wants to give billions and billions to Ukraine to fight a proxy war on its behalf and empty out the military-industrial complex larder as well, so that they have to buy more, you understand. That's where you can do all the wash trading with all the seedy brokers and intermediaries and get 10% for the big guy, please. Yeah, but let's put that aside for a moment and let's just have a look at these key markets. This is your 30-year. This is your 30-year. I'm putting it on a log scale now for everybody so that you can see it. It takes some of the sting. It reminds you what a massive collapse and how bullish it was for bonds at that key point. People in bonds made money. However, this is turning into a potential key break. Taking off the log scale so you can see the emphasis. This basing ascending grind line from that broadening structure over there that pointed to further upside continuation. Then the melt back down to the grind line. A secondary bounce and another bounce of a marginally higher high, not bullish. This is pointing to a breakdown from here, and we expect movements down in this direction. Let's draw. There may be a third impulse rally before you go over. That could happen, and you can get, hence the wicks. Note the wicks, buying back up, buying back up, buying back up, buying back up, buying back up. In other words, people selling bonds. There's a problem, actually. There's too many bonds. There's not enough liquidity, but now everybody's afraid. It's creating temporary demand and downward pressure on the rates. So this is the yield. Remember, this yield going down means the valuations going up. Let's have a look at 10-year yields. 10-year yields. So we'll have a draw and a little blunder look over here. So you are going to get a pullback. Where could you go? Some of you might ask. Where could you go on the treasury yields? Let's log scale that as well. That'll just remind you what a capitulation that whole story was in the events of March 2020. Let's get some fullness of the screen over here, and we'll highlight to you a couple of areas where we drew forensically. This 3 is a big level. You could dip down here and potentially violate and or bounce and support down here. So I'm saying sub 3. 2.9s are possible on any down pull, depending on the scale of the demand destroying event that they have planned for us. Problems with Credit Suisse? Yes. What do you think the demand destroying event will be? War escalations, China, South Pacific Sea. Is Australia getting involved? They've been getting all aggressive and showing how pro-America they are, choosing the wrong team at the wrong time. Good old Aussies. Yeah, but of course it's not the Australian citizens. It is their political classes that are there and designed to bring mayhem into their world and divide and conquer. And they will be on the wrong side of the BRICS equation, because it's not a great way to get an invite into the BRICS as an Australian dollar if you are actively getting military and buying submarines, a fleet of submarines to the tune that every Australian, 30 million of them, will carry over $1,250 per head just for this brand new purchase, running into multiple hundreds of billions. Wow, that is the world. That is the military industrial complex. We've said already that that's one of the few industries that will in fact fly in this environment to the long side. So that's the 10-year yield. Look at it. It's having a bit of a down push. Let's have a look at it on the lower time frame. I want to highlight that this is not good price behavior. This is an absolute smack. This is events, dear boy. This is no longer upside. You've made a marginally lower high, and now you're coming down with far more momentum. I would imagine that these lows can be violated. But first, because of the volatility, there might be some mood calming exercises that will initially see a rally. Don't be so easily put off the scent by the fact that there could indeed be rallies around. It's quite likely that there's a broadening structure in the brew here, and you will at some point come later down here to break. But it could come after a move back up to the central splitter of ascending, broadening megaphone before you break to the downside. That would be it. That would be it. That would be it. in terms of that possible structure. But it is that 30-year. That 30-year, I tell you, I don't like the look of it. But let's go past the shorter time frame debts, clearing the face. This is a proper slap in the face. We have real phraseology for this under Hunt volatility funnel method. These are key moments happening right now. We are telling you, before everyone else is telling you, that the demand destroying event, my friend, is on its way. This is a real turn. So everybody's been waiting the pivot, and now they're not recognizing that this is in fact probably going to be an environment where risk is going to become a real problem, preservation of capital is going to become a real problem, and some money will go into the debt markets, but even more is going longer term into gold, and some is finding its way as well into Bitcoin and the crypto. So you imagine, and I imagine you will see good funds going into gold during this period. This is a real jaunty slap in the face. This has taken low volatility, and we always talk about low volatility to high volatility extremes. It's when you get some of your best risk reward trades. Super low vol all over this period. Little push up, a little bit higher, beep, 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 slam. That is a trend changing event. That is a short, sharp slap in the face. Dish. That's it. And despite what rallies may come, we expect to see a pullback. But as I've said before, this is not bull bonds the whole way. Yes, you probably make some money trading bonds. As I've already said, I won't go there, but you'll get a pullback some of the way. But because of the hyper stagflationary nature and the costs of things, that any long-term over reduction in interest rates or excessive QE will push prices up disproportionately high. This is why we coined the phrase long before anyone, in fact, I'm not even seeing anyone trying to copy us yet. They haven't realized how accurate we are yet. Hyper stagflation. In other words, these rates start coming down a little bit as they will because of no growth, fear, no investment, and boom, prices going up because they're QEing and dropping rates. That is the inverse Goldilocks economy that Greenspan supposedly bequested you. And by turning the wick up, he gave you too many days of just day. Now you have burnt all your oil and it's night. And that is the gift, and that is why he is the most damaging Fed chair and should be in The Hague for economic crimes against all of humanity, creating a precedent of liquidity and a no-pain economy that has led to absolute destruction. And it is by intent, as I continue to say, it is by intent, this destruction. If you have a look at the 2-year, you can see here what a vicious slap, grinding up slowly, and then wham. So some of you might be asking, the smart amongst you might be asking, Francis, what about that thing you turn along? I'm here to tell you about the inversion of the yield curve. That's right. I am here to tell you about the inversion of the yield curve. This is what you're going to hear, and this is what you're going to see. Here are all the yield curves inversion. This is the big blue line that is on the zero line. There it is. There he stands, so bold, nice and clear for you to see. Put him back on exactly naught, please. No slipping and sliding. So what have we had? My theory is the following is taking place. We are seeing a strong rebuttal of an almost record low, not since pre-80s. Did you get such a strong yield inversion? We were down through 1% in a very short, we were minus. So let's be clear, that's minus 1% through the minus 1%. Look at that low, minus 1.08%. Today you have snapped to above minus 0.4. You're actually at minus 3.95. So in the single month, you have reversed from 1.08 to 0.395 so far, and the month is but a little fetus baby, a cute little giggly bundle of fun that is yet to pee in its nappy. That's right, my friends. That is what's happening, and it's coming up fast. So the key thing about these inversions, the harder and the faster you dip, wham, bounce on the zero, slam, that the harder you tend to come up. You see more rounded casual bottoms over here for the subprime, a bit more like that, not nearly as vicious as intent. This is vast, and the problem you have with this is that the bounce back up is also often regularly vicious. What's happening? The rates market, we've been highlighting on this channel that people need to understand the failure of the fiat system starts with debt. the debt system. All currencies are borrowed into existence. You had to start watching the bond markets. We have told you about bond markets. We have told you about the direction of the dollar and the bond markets. We started helping you make these associations over the last 2 years. Bond markets matter. This is a debt-based system. The failure of the debt-based system, which will mean the currencies, the alter ego of the creation of a currency is the creation of the debt that underlines it. Every currency is an asset and a liability. Gold is not. You hold it, you own it, or you don't. There is no liability associated with it once you purchased it. The creation of money is an instant debt. And this is what you're seeing. These are the debt markets. This is the failure of the fiat system as it currently stands and the loss of confidence. And you've seen a massive move in the month so far, and we are on. Beware the Ides of March, he says. 15th of March, indeed, indeed, indeed. It's all going down. This is rapid. If you were to continue in this rate, it would be quite feasibly possible that even in the next month, or possibly if it really pumped and things escalated super quick during the course of March, you could break back above. The key thing I'm showing you on this chart is the inversion is a leading indicator. The inversion is a leading indicator of the subsequent crash and its events. All the downside is still going to happen, despite our oil market already trading down, as we probably haven't yet shown you, but this was something we've been in for a bit. There you go. Beautiful chart, beautiful draw. It's absolutely spilling. It's spilling, spilling, spilling. And we've given you this for a 40%. There's your inverted HVF. There's your triggering event. And here is your complex head and shoulders blow off moon down into there. It's a spiller. It's an absolute thriller. And we say to you that it is going to go down, 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 potentially by 40%. You could even get oil at a 3 number, $38, $39. But when we were talking about this, it was $75 and $76. And now it's trading already in the 60s, I believe, around 67. I'll confirm that in a minute. So this chart is Western Texas Intermediate divided by the Dixie. That is actually a chart including the euro, the pound, and all the other currencies. Why? Because the dollar has become too much the story. To keep gold down, most people only understand the gold dollar price. To hide the fact that inflation is rife and is actually running, they've had a strong dollar policy for an extended period. So by measuring commodities against other currencies or baskets of currencies such as occurred, and we tend to do this as 360-degree analysis, and it was one of my community members that brought this one into the front. If you want to be part of this community, you want to have a better idea of what we're shorting, you want to have real mentorship at these key moments as the markets are turning. I've never felt the need to YouTube so much to tell everybody, but the first people that must be served are the people inside the community in terms of trades and what is going down. This is where we're at. This is what we're doing, and that oil is turning and it is throwing down. It is one of the cleanest, purest breaks I've seen, and it's trading at its low, and it will go further. In our overall opinion, we have a target that will take you in and around the 38, 39s, which from the 75s that it was at represents at least 40% odd. I would argue you're looking at about 35 out of 70. You could even be 45, 50% down from that $75 oil. That could be quite substantial. You could be looking at mid 30s as well. So that is a demand destroying event. What happens? People stop traveling, people stop driving, people stop spending, people stop buying things with packaging that is used in oil. All forms of retail activity, the retail consumer will potentially be badly hit. Don't waste money right now. You should be investing. You should be coming on board in this community and building wealth right now in the volatility that the Fed machine is creating. All you have to do is understand the mechanisms of the game. Back to that yield curve. So what are we saying? The highs on the yield rebounds are going to reduce likely, in our opinion, and the dips are going to increase likely. In short, this will come up and bounce, but I don't think it'll get too far because the appetite for debt has turned since this event, CV19, which is that wick over there. The bond market has ended its bull run. So I think it's going to generally remain less differential between the 2s and 10s, and we're going to be very close. This is typical of hyperstagflation, very close to recession and inflation simultaneously, high inflation simultaneously. You'll be experiencing both. There's no place where you aren't experiencing either terrible levels of growth or very high inflation, and only the pain level of each will vary. So your one leg is in a bucket of ice and the other's in the fire, and you can lift them up and down for a few seconds and you can swap feet, but in the end of the day you're getting burnt in the fire and numbed out and frozen and frostbite in the ice. And that is because that they have engineered this economic environment. So this rally over here could go up once it goes up here, but this is the crisis. The red boxes are the actual crises. The early 90 crisis actually was formed and you broke below the zero level pre-1989. That was the crisis that got Bush thrown out and saw Clinton get in. And that economic crisis only reversed and you reached 89, 90 levels around about 93. So the crisis came here, the early 90s crisis. But the inversion was already 88, 89 after a tightening of rates, after the blow-off back up of stocks in 87, recovery 88 through 89 into the early 90s, brought inflation as a fear back again. Also during that period, less was being spent on the military-industrial complex because we had the fall of the Berlin Wall. That was all what was going on over there. You almost had an inversion and a very low dip. This was the beginning of the Asian crisis that happened here in 97. There you can see it, but your first warning, close to the zero but not running the zero, came during the late 84 period, the late 84 period. So the Asian crisis, and then into long-term capital, which came in over here in 98 and was the problem with the emerging bond markets and the over leveraging of Merton Scholes and all the supposedly wise men that got away with a bailout that told them it'll be okay. This was a drill for the banking bailouts that came later in subprime. The first pop of inversion on subprime, you can see that date. Let me get a straight line so I'm not drawing all wonky. You'll see that date over there came around about over there, and that was 2005. You hadn't even turned 2006 yet, and you were already getting warned of the flattening of the yield curve. By the time you broke out, you were in the deep dwang round about 08 after the Lehman's into 09, and you stayed in the red zone for well into 11, and it was a very weak recovery in the global economy during this period. Again, you came all the way back down. We had the repo. We had the repo issues. So from subprime, there was a largely considered an 08 event with an absolute low during 2009 of misery and poverty. You could have bought the equities for peanuts and a bag of chips, and you subsequently would have had an unbelievable run on the reflation of assets. But this time may not be so good. Gold will be probably a better bet, and miners, as equity is falling out of favor with its hypervaluations, and as the bond market has turned on its 40 years valuation. This is the season for commodities and owning physical things, despite them pushing you into the metaverse. So this repo liquidity, when did you first dip down? Again, if we show you this was on the first negative shout right there, early 19. It got hairy around about September, October 19. You had already reversed on September, October 19, and you went into COVID over here, right there, the scamdemic, and there she blew. Up, and then you ended up back down. When did you first warn that there was a yield curve inversion here? That was in and around 2022, a third of the way down, and now you've had the bottom. The bottom, in my opinion, is in for the yield curve inversion. It's already one of the deepest of the modern era. There is no other that is deeper until you head back to the 80s, the early 80s of Faulkner, which was associated with rising interest rates, loss of value in the bond market, and a massive chase into gold. That's right, my friends. That is right. That's where you are today. The economic shenanigans continue with the control structure. If this inversion continues, I don't think you'll go as far, and you could be ready for another smashdown event. All of these will be very beneficial for precious metals as the alternative to money. So this is our call. This is a turning for bond to have a serious pullback in what is generally going to be stubbornly high yields. Whether you will make it new highs on yields in the future will remain to be seen. We may have a reset before then. This demand destroying event may be, oh, the crisis that couldn't go to waste. So there on the sidelines, we had these ready to go, baked just for such an event as this, central bank digital tokens. And now you can have debt forgiveness, providing you sign here, have all your Maxines, social scoring, and you accept CBDCs that have to be spent by then, can't be saved, can't buy that, can't buy this, can't do it, etc., etc. They may just introduce them and say, look, there's no restrictions, we kind, and those come in thin edge of a wedge slowly over time. You tell me how they're going to play it in the Great Reset. We've been calling this for 15 years. This moment is coming. This reversal is a pullback in the rates, and we'll see bonds get a rally, but they will never go up like they once did at the end of March 2020. That was their nadir. In short, debt is going out of fashion. That is why gold, my friends, gold is the one running. And that is why TLT is in a secular head and shoulder and has made a target and is slightly up, but in the long run, even if it rallies here for a while, will eventually be lower or back down. Let's have a look at that gold just to remind you, the gold Australian dollar call that we've made. This was discussed in our community. Look at that baby go. 2,919. Take you to the weekly. Take me to your leader. The men down here are insane, said the alien to whomever he spoke to. I don't know who he's speaking to. Why would he speak to anybody? I don't know. That's a bad idea, maybe. 2,800 was a critical level where you had just temporary, very short-term spikes through it, and you came and kissed again. This is a seminal break. There are real seminal breaks. Unfortunately, in trading, you have massive periods of famine and all the macros don't work, and then suddenly everything starts to happen, and then suddenly it all starts to move, and you don't get to, you go from complete famine to absolute feast. You can't put your hand, you can't be in all of them. You will spoil your money management, you'll spoil your risk management, you will oversize. You've got to be careful, and you'll also be highly correlated. This is a reset trade. You are witnessing reset trading. We specialize in building wealth in reset times. You should be short on most of the energies that we have put in front of our community. You should in fact be making real money. You should actually be biasing to the long side on Bitcoin. You could have got in at just sub 20k on a right shoulder. You could have got in again midway when we were updating the community. You could have got in at the just-in-time entry at 25, which will be taken again after its triggering event. But you would have had to be small because you had a highly impulsive shoulder. Understanding tight risk and expansive rewards in key moments, and using lower volatility events like the actual HVF squeeze that gives you a squeezy like this that could have seen you with stops over here and entries there, and even optimized better within that. Across multiple time frames of analysis, we preserve capital with tight money management and real big moves. So there you go. This is a bond bull call, but not for investing. It's going to be a rates cut. I think we've made peak rates now. There might be one or two increases by Lagarde tomorrow, 0.25. They were supposed to do 0.5. Now it's 0.25. So all the things that are put in play may end up happening. But the market is saying it doesn't want much more. And this could cause real tension. We've got Credit Suisse that we never showed you, which is trading at near all-time lows. It's the new Deutsche Bank of this brigade of hopeless banks. Remember, along with the debt and along with the FX markets, the intermediaries and the creators of these debt are in fact the banking cartel. That is Credit Suisse, now trading 1.91. Their investors, the Arabic bank, says no more funds for you. No more funds for you. DJP was the index that we were watching, that we'd done a draw on some time ago, warning that the commodity index is going to trade down. Look at that trade risk reward. When last did you land a 15.24? You could have been short this. There are puts that are available on this index on various brokers. You could be short commodities. This is a spiller. It's a thriller. It's going to make that target. It'll probably have a bounce at the neckline before another leg down. Who knows how it might play out, but things are happening fast now. You have entire months where nothing happens. You have decades where nothing happens, and you have days where decades happen. It's a famous saying, and this is where we're at right now. Bull, bull, bull for gold. Yes, sir. Yes, sir. Pure gold link below. Buy silver or gold. Gold is leading, but it will pivot to silver. You could position early by taking silver as orders as well. This would be smart to have a mix of both. Bars, coins, you name it, delivered to your door. Real understanding, people who talk to you when you place your order and truly understand. And of course, the main link to come and join our community and book a call at these moments. Activity is high, bond market down. What do you think that means for your pension? If the bond market gets a little bit of a bid for now and yields go up, but then the entire equity market crashes. Your pensions also have equities. You're going to see downsides on the equity markets as well. This is not a time for David Hunter's 60% up in the equity market. This is real fear and contagion. And this is where you are at right now. Until next time, I give you a salute and say, we'll see you in the community. Link below in the description. Book a call, have a friendly chat. No commitment either days. 14 days for you to say, not for me. I don't know any better reasons not to be building wealth. And if we can't, over the course of the reset period, earn you back not only your investment, but a multiple on it, then, you know, it's been a difficult and bad performance from both us and you. Till next time, I'll catch you later. Goodbye.